What's up guys, and welcome to Wall Street Millennial. One of the biggest moves in the market today came from the SPAC Churchill Capital Corp 2, or CCIV, which tanked by almost 40% today on the news that will be merging with Lucid Motors, a California-based company that will produce luxury EVs. The reaction from the stock price seemed counterintuitive, as Lucid is an innovative company that has the potential to disrupt the luxury car market. With the EV craze over the past year, you would think that investors would be excited to participate in the hottest new EV stock. Furthermore, there has long been speculation that CCIV would be merging with Lucid, and this speculation sent shares increasing almost 5 times from the initial SPAC price of $10, as investors are largely bullish on Lucid as a company. But on February 23rd, when the hyped-up merger with Lucid was actually confirmed, shares tanked almost 40%. So what can explain this price action? Part of the decline can be attributed to the terms of the transaction. At about the same time that the SPAC deal was closed, Lucid also raised about $2.5 billion from a PIPE deal. A PIPE, or private investment in public equity, happens when institutional investors buy into a company at the same time as a SPAC. This is often a controversial practice because the institutional investors in the PIPE often get a more favorable deal than the retail investors that buy the shares of the SPAC, and this is exactly what happened with Lucid. The SPAC, CCIV, bought a 16% stake in Lucid for $2.1 billion. They raised this $2.1 billion by issuing shares at $10 a share. As speculation and hype around the deal increased, the shares rose all the way up to $57 a share on February 22nd. At $57 a share, this implied a $73 billion valuation for the EV maker. After today's sell-off, the share price sits at about $35 a share, implying a $45 billion valuation. In the PIPE, institutional investors, including the Saudi Arabian Sovereign Wealth Fund, BlackRock, Wellington Management, and others, bought a 10% stake in the company for $2.5 billion, implying a roughly $25 billion market cap. Many retail investors were outraged by the PIPE deal because the institutions were able to buy into Lucid at a significant discount to the valuation implied by CCIV's share price. The Saudis and BlackRock essentially were given free money because they bought into Lucid at a $25 billion valuation, while at the same time the implied value of the company was upwards of $70 billion. Lucid CEO Peter Rawlinson was asked about this very issue today on CNBC.
So Peter, one of the things I think our viewers, they're so excited. They wanted a piece at Churchill. When you try to figure out a price, did you say, listen, you know what, we're every bit as good as Tesla, if not better, but we're priced underneath Tesla, so therefore anyone who thinks that this is overpriced as a stock is missing the point, which is we have more technology, we have faster charging, we got a better car, and we're cheaper than the stock of Tesla.
Well, I think there's a gross misunderstanding on the market, actually, Jim, because actually the price, the acquisition price of Lucid from Churchill was $11.75 billion. That was a snip. It was a great deal for Churchill, but there was a quid pro quo. Churchill brought this incredible array of the bluest of blue chip companies to invest in us with long-term commitment, with a lockup and a commitment. And those companies provided we were oversubscribed for the PIPE. So we actually expanded the PIPE, and the PIPE sold at $15. And this is unprecedented in the history of SPACs.
So he explains his company's rationale for selling equity in the company at a discount in the PIPE. Big institutions like the Saudis and BlackRock are big, respected institutions with long-term investment horizons, so it was worth it to them to get on board as shareholders even if it means diluting the equity and selling at a discount. This is exactly the type of favoritism that disenfranchises many individual investors from Wall Street. It seems like every time, big Wall Street investors are able to leverage their connections to get a favorable deal at the expense of retail investors. This is exactly what happened with CCIV. This goes to show you have to be extremely careful when investing in SPACs because the exact details of the transactions can be complicated and often not transparent. And while many SPAC sponsors claim SPACs are a way of democratizing investing and giving retail investors more opportunities, the reality is that retail investors almost always get a worse deal than the big institutions. There's also another case of SPACs screwing retail investors from early February. On February 4th, the famous research firm Hindenburg released a report about Clover Health, one of Chamath Palihapitiya's recent SPACs, accusing it and Chamath of misleading investors about the company. In the report, they say that Clover Health and its Wall Street celebrity promoter, Chamath Palihapitiya, misled investors about critical aspects of Clover's business in the run-up to the company's SPAC go-public transaction. They said, "Our investigation into Clover Health has spanned almost 4 months and has included more than a dozen interviews with former employees, competitors, and industry experts, dozens of calls to doctors' offices, and a review of thousands of pages of government reports, insurance filings, regulatory filings, and company marketing materials." Hindenburg goes on to say, critically, Clover has not disclosed that its business model and its software offering, called the Clover Assistant, are under active investigation by the Department of Justice, which is investigating at least 12 issues ranging from kickbacks to marketing practices to undisclosed third-party deals, according to a civil investigative demand, similar to subpoena that we obtained. Back in 2016, Clover was fined for misleading marketing practices by the Centers for Medicare and Medicaid Services. The fine was issued after Clover's repeated failure to amend misleading statements about its plan offerings. A former employee told us that the fine was so small it just emboldened Clover to push the envelope further. Here's what CNBC had to say about the allegations.
But importantly, Clover said this morning that it did receive a notice of an SEC investigation and says it intends to fully cooperate. And perhaps more importantly, it acknowledges that Hindenburg's research saying that there is a Department of Justice inquiry taking place and that they're cooperating with that inquiry was in fact true and something that they did not disclose. They said they did not disclose it at the behest of their lawyers, who said that it would not necessarily be required to be disclosed, arguing that it was not material, but that in fact Chamath Palihapitiya and other investors and people involved in this transaction clearly knew about it as part of the diligence process in advance. Of course, the public did not know about that in advance. They're now saying they didn't have to tell the public about it in advance, saying that there are lots of inquiries in the Medicare space like this, and that this was, quote unquote, I don't know if they used the word routine, but that was the idea that they were trying to get across.
The major problem with this for most people watching this channel is not that Clover is misleading customers and taking advantage of Medicaid recipients, but it's the fact that they are under investigation from multiple governmental regulatory agencies and did not disclose this to investors. Instead, Chamath Palihapitiya touted the company for creating transparency, saying, quote, "They don't motivate doctors to upcode or do all sorts of things to get paid." But the Department of Justice is specifically investigating the company for doing just that, encouraging doctors to overbill Medicare. The scale at which the company misled investors before the closing of the deal, when looking at it in retrospect, is shocking.
So what is this business? In the most basic form, what consumers need to know is Clover offers simple, obvious, and comprehensive healthcare plans for all of us. And so when you go to Clover Health and you sign up for one of their plans, what they also do is go to your doctor and give them very powerful software. That software is a combination of machine learning that takes all this heterogeneous data, clinical data, drug data, your lab results, your blood results, your genetic information, merges it together and allows them to give actionable insights and recommendations every time you see your doctor. That allows them to deliver better outcomes and lower costs. In fact, when you're a Clover member, you see 22% fewer hospital visits and 23% fewer ER visits.
So basically, according to Clover and Chamath, Clover does its magic by creating a software suite so powerful because it uses machine learning that it can reduce your need to see a doctor by almost a quarter. Meanwhile, doctors who use that software say it's, quote, embarrassingly rudimentary and a waste of their time. To give a little bit of background on the people who run the company, the founder and CEO of Clover previously owned 3 for-profit hospitals in New Jersey. Those hospitals were publicly condemned for price gouging on even simple hospital visits. It was reported that they charged the highest prices for hospital visits in the entire country. After attracting unwanted regulatory scrutiny, he made a $1 million donation to the mayor through a shell company, which was only revealed to the public after a nonprofit sued to expose the shady donation. Alright guys, that wraps it up for this video. What do you guys think about the CCIV fiasco? Is it another example of Wall Street screwing the little guy? Also, do you think Chamath should have disclosed the investigation at Clover Health? Let us know in the comments section below. As always, thank you guys so much for watching, and we'll see you in the next video. Wall Street Millennial, signing out.